Learning how to beat the Wizards of Wall Street at their own game with options is similar to improving your golf game. You can't get very far unless you unlearn your old bad habits. With options, popular misconceptions have been advanced by many books and by social media. Today, it's time to slay a few option trading myths. Myth number 1. Selling options is inherently risky than buying them. Here's some statistics to settle the debate. 85% of all option sellers make money. It's the option buyers that are mostly the losers. Therefore, sellers are the basic winners. While selling options involves different risks, it can be less risky when coupled with proper risk management strategies. When people hear the word options, they often break out in a cold sweat. Options, when used correctly, aren't overly risky. Most brokers won't allow risky usage for beginners. Selling unhedged options is the risky approach, which is uncommon in reputable strategies. At Dividend on Fire, we advise against it, even if your broker permits. Our strategies involve covered calls and cash-secured puts, both hedged, ensuring fixed and understood risk. Surprisingly, selling these options on a share is less risky than buying the share outright. Yes, that's right. The sale of the option not only brings in premium, but it also reduces the risk in owning the shares. As you master option selling, you realize the strategy can be used for income purposes or for adjusting the cost basis of shares you want to own. Although there are still risks, selling options definitely operate in the shallow end of the equity risk swimming pool. Okay, so myth number 2. Option selling is only for advanced traders. The reality is selling options can be accessible to traders of all levels. This is especially true with the availability of beginner-friendly resources and educational material, which we try provide here. This is the main reason I started to document my options journey with dividendonfire.com. It was to lay down a solid foundation for options traders to come, so they can read, learn, and ultimately become better equipped to navigate the world of options trading. Myth number 3. You can only make money in a bull market. The reality is option selling can be profitable in various market conditions, including bear and sideways markets, not just in bullish trends. Option selling provides a unique advantage to traders by allowing them to generate income regardless of the market's direction. Throw at us a bull market, bear market, or sideways market, it does not matter. The true power of option selling lies in its adaptability. When the market moves within a range, option traders can capitalize on the lack of significant price fluctuations by selling both covered calls and cash-secured puts. The key takeaway is that option selling provides a versatile toolkit for traders to profit from various market conditions. By understanding and implementing the right strategies, traders can create a consistent dividend-like income stream. This is irrespective of whether the market is bullish, bearish, or going nowhere. This flexibility is what sets option selling apart as a powerful approach in the world of trading. Myth number 4. Option selling is not suitable for small accounts. The reality is capital requirements for option selling vary depending on the strategy used, but it also depends on what stocks you want to trade options on. The rub with a smaller account is that you are more limited to which underlying securities you can trade. If you only have $10,000 account size, then you can't sell a cash-secured put on Tesla, as this trades at above $200 per share, and one option contract represents 100 shares. Diversification and position size is also a bit trickier with a smaller account. Instead of having a max position size of just 5%, you might have to contend with having a 10% maximum instead. Myth number 5. Option selling is only about premium collection. Successful option selling involves not only premium collection, but it's about being able to successfully adjust our cost basis per share on stocks we want to own long term. You can focus on being a more value-based option investor, and I believe value investing plus short-term conservative option strategies puts you in greater control of your financial future. Okay, so what does this mean? Well, in my tax-free long-term portfolio that I have, but I can't trade options in, the only way to reduce my cost basis on the shares I own is by purchasing more shares when the stock price drops. This approach may not be the most effective for maximizing my profits, but it's the only tool I can use in my toolkit. So, how do we get around this with options? By using the option strategies we preach at dividendonfire.com, you have the chance to reduce your cost basis regardless of market conditions. This has significant implications. Maintaining a consistently lowered adjusted cost basis means minimizing or even eliminating losses in a declining market, gaining when the market is stable, and reaping even greater profits in an upswing. Adjusted cost basis might sound, well, a bit boring, but it's our secret sauce as value-based option investors. In essence, embracing the adjusted cost basis mindset allows you to consistently acquire stock you want to own at a discount and continue receiving ongoing dividend-like income through writing covered calls. Myth number 6, it's not suitable for income generation. The reality is option selling is a popular strategy for income generation as it allows traders to collect premiums, which can be a consistent source of revenue. If you don't believe me, then check out some of the interviews I've done at dividendonfire.com with full-time option sellers. Some of them earn over $20,000 per month selling options. These people live the reality of producing a consistent stream of income every single month from stock option trading. Myth number 7, option selling is only for full-time traders. Selling options can be adapted to fit various schedules. Some strategies, like covered calls, require minimal time commitment. Depending on what time frame you decided to trade options also plays into how much time is needed. I have found personally that weekly options do require a bit more management. Options that expire monthly generally are more hands-off until perhaps the final 2 weeks before expiration. This is when I generally decide if I am going to let the option expire worthless, buy to close it, or roll it out to the following month, hopefully, for a net credit. Myth number 8. There is big money to be made in selling overvalued options, meaning the ones with high premiums. The good news is that over 80% of the time, this statement is correct. You will make money selling overvalued options. The bad news is that the other 20% of the time can cost you far in excess of all the profits you've made. This is because when selling cash secured puts, your profits are strictly limited to the premium you receive. However, your risk is not. And over time, all markets make giant, unexpected moves. Getting caught in one of these moves without a trading plan can wipe out months or years of profits. Believe me, I've encountered this situation many times when selling puts on stocks with high implied volatility and juicy premiums. It can go smoothly until suddenly it doesn't, and then it can lead to significant losses. Not only do you experience losses, but emotionally, it can take a bit of time to get your confidence back. So avoid chasing high premiums on stocks that you would never want to own in the first place. Okay, that's a wrap for today. I hope you enjoyed the video. Please like and subscribe to my channel, and until next time, take care and happy investing.